The Bank of England is suggesting that inflation will fight inflation, and therefore you don't have to expect as many interest rate increases. Meanwhile, Jerome Powell in the US is suggesting that a 50 basis point increase to interest rates isn't off the table because of, well, inflation. So this is the conundrum that central banks all over the world are facing. Do we raise interest rates? Are we going to have to worry about inflation? What does it do to growth? And what are all the issues that we have to address when we're looking at the higher prices for pretty much everything across the board? And that's what we're going to suggest in this video. We're going to talk about everything from how Ukraine is causing higher energy prices and how that's going to filter through the economy, to the conundrum, like I said, that the central banks are facing when looking at interest rates, because it has very rarely ever been seen a situation where we have high inflation with very low interest rates and a lack of certainty on what rising interest rates will do to the economy. But before we get into all the details, do me that favor, hit that subscribe button and that notification bell, and please hit that like button so more people like you will see this video. And don't forget about our race to 25,000 subscribers, where we're going to give away $5,000 to one lucky subscriber just for subscribing to the channel. In order to win, though, you have to be subscribed, and stay tuned for details on how you can win that money. We're almost there. We're less than 2,000 subscribers away from giving away that cash. Okay, so let's get into it. Let's discuss everything inflation today, because the world has turned. And this is one of those things in economics where the surprises are the things that make economics interesting. And they're also the things that make it really hard to predict what things like inflation and interest rates are going to do in the future. Because several months ago, when we were talking about inflation and we were talking about interest rates, there was reasonable certainty that there was going to be a slow run up in interest rates, but what happened after that was anybody's guess. And then lo and behold, all of a sudden we get this major headwind in inflation, which is the Ukraine crisis, that has led to higher energy prices and subsequently higher inflation pretty much across the board. And those higher energy prices will be reflected in everything from heating costs to transportation costs, to the cost of your food, to the cost of buying things online. Yes, you can expect the prices of things that you're buying online to go up as a result of inflation, and partially due to what's going on in Ukraine. And that leads to a really interesting conversation around interest rates and what's going on around the world. Different central banks are looking at this in different ways. I'm going to pull up first and foremost an article from Bloomberg. This is a really interesting headline: Inflation fights inflation in Bank of England strategy for the UK economy. And yes, you are not reading this wrong. Inflation is expected to fight inflation in the UK, and the central bank there is factoring this into their decision making. The reason why is because when you have inflation, it leads to higher prices for things, higher prices for goods. Higher prices typically lead to lower demand, which means eventually prices go down. And this is really being seen in the scenario with respect to energy prices that is taking a lot of dollars out of people's pockets. And that's having an effect on real incomes, which basically means because heating costs, transportation costs, and costs for generally everything are more expensive and wages aren't rising, what that means is that real wages are actually coming down compared to the cost of goods. And that typically leads to less demand, less growth in our economy, eventually probably a recession of some sort. And at the end of the day, it's going to lead into this cycle where we're probably for the next few years going to see rates of high inflation, and then we're going to see the number drop back down, then we're going to see it spike back up. And the big worry that the central banks have right now, and this is especially true for the Bank of England right now, is if they start raising interest rates and they raise them too much, then they could end up in a scenario where the increases in interest rates combined with inflation have a negative growth effect on the economy. And that means that people start losing their jobs. It means there's less money to go around. And as a result, there ends up being this deflationary pressure that could come up in the next year or two or three. And that's what the Bank of England is suggesting that they're afraid of right now, is all of this inflation leading to a scenario where growth is dampened. And then that ultimately ends up knocking out inflation and makes things less expensive because there's less demand. So that's one take. And that leads me to this next article that I want to point out, which is that Jerome Powell is suggesting that he's ready to back a 0.5 percentage point increase in interest rates in May if inflation doesn't start to back off a little bit. Now, we already know that energy prices are getting more expensive. That's leading to less money flowing through the economy, but it's also leading to higher costs of goods throughout the economy. So my guess is that if Jerome Powell is suggesting this at the moment, that there is a high likelihood you could see the Federal Reserve in the US increase interest rates by 0.5 point come May. And they're taking the opposite approach to the Bank of England, going, well, we are so worried about inflation that we are going to increase interest rates faster because we're afraid that it may get out of control. So on one hand, you've got Bank of England saying we are less worried about having to increase interest rates because inflation is going to fight inflation. On the other side, you've got the Federal Reserve now saying we need to do something to fight inflation because what we've been doing hasn't been working. Not raising rates hasn't been working, and therefore we need to do something drastic like increase interest rates by 0.5 percentage point. So you've got this dichotomy. You've got Bank of England suggesting one thing, you've got the Federal Reserve suggesting another. And at the end of the day, the reason why they are suggesting different things is because in an economy like this, whether you're in England or the US or in Canada, it becomes really, really hard to figure out what to do with monetary policy when you've got really low interest rates and you've got this issue of high inflation and stagnant growth. And the prospects of increasing interest rates could essentially kill growth and put you into this negative tailspin, which would be even worse than the inflationary pressure because it would lead to job losses and really bad things happening in the economy. Think like Great Depression, or at least think recession. And more than likely in the next year or two, we're going to be talking about the next recession. You've already seen it on YouTube. If you follow these things, lots of online finance YouTubers are already talking about the next recession because, quite frankly, with interest rates going up, inflation high, and so on and so forth, things are probably going to get worse before they get significantly better. Now, as soon as Jerome Powell suggested that there could be a 0.5% increase in interest rates, the bond market, which was already crazy, by the way, went even crazier. And keep in mind that the bond market is what dictates where fixed interest rates go. So we've seen a lot of activity in fixed mortgage rates over the last week. In fact, last week, my team was absolutely going bonkers because pretty much every day we were getting a notice that interest rates were increasing again. And if you go ahead and you take a look at the 5-year bond yields, this is for today. We have about a 15 basis point or 0.15% increase in interest rates. This will be reflected in the coming days in fixed rate mortgages. So if you're in the mortgage market and you're shopping, make sure you get a rate hold. Make sure you get a lock in for a rate hold so that you're protected from rising interest rates. By the way, if you're also in the market for a mortgage right now and you want to know how to get the lowest interest rates, you can go to ratesecrets.ca, take our course on that. It gives you all the information you need. And more specifically, it tells you the information you need to avoid landmines and surprises that could end up costing you a pretty significant amount of money down the road because you ignored everything and just went for the lowest interest rate, because the lowest interest rate isn't necessarily the thing that saves you the most money. What typically saves you the most money in a mortgage is the features and so on and so forth. And that course teaches you all about that so you don't step over dollars in order to save pennies. Now, going back to the 5-year Government of Canada bond yields, you can see that this interest rate has jumped up quite a bit today. I want to show you what it looks like over the last month because pretty much this last week here has been chaos in the bond markets. We've seen this interest rate go from about 1.8% up to almost 2.2. That's a 0.4% increase in 5-year fixed rates, or almost a 0.5% increase in interest rates. So this leads to a really, really interesting conversation about 5-year fixed versus variable, because obviously we had this unpredictable thing, which was the Ukraine crisis that came up and bit us in the ass on interest rates, and is leading us to wonder, what do we do next? What's the next step with respect to interest rates? And what do we do with our variable rate mortgages or our fixed rate mortgages? What mortgage do we choose right now in order to make sure that we are preventing ourselves from getting our butt kicked by rising interest rates and inflation? And this is a conversation that's going to get more difficult over time, because even the best economists don't have a clear crystal ball on any given day. And making forward-looking statements and forward-looking predictions is easy based on the information that we have in the moment, but extremely difficult knowing that the information that we have is probably going to change on a pretty regular basis. And that's what happened when Russia invaded Ukraine. All of a sudden, we saw higher energy prices. We saw the nickel market go crazy as certain markets started to expect that there wasn't going to be a big enough nickel supply going forward due to supply chain issues related to that war and that conflict. And ultimately, what ended up happening was we have this new set of data that affects our forward-looking predictions. And the bond market has reflected accordingly a higher interest rate for the 5-year bond and the 10-year bond. And that plays into our mortgage decision-making. And then the question becomes, how do we choose? Well, we know we're probably going to see interest rate increases in the near future here. My guess is that the Bank of Canada will increase by 25 basis points to 50 basis points come April, and it'll continue to go up from there. But when we look at this conversation about what's happening in the UK, where they're saying that inflation is the snake that's eating its own tail, and therefore we should start to see inflation start to correct itself somewhere in the near future, then we've got the US Federal Reserve that's saying, no, we need to act fast and we need to act quicker than we thought. Well, what do? And I keep coming back to the same conversation over again, and it's this conversation around risk and assessing the difference in costs for you, and then determining if it's worth it to you to make the risk. Because as of right now, as of this filming, and this will probably change tomorrow, if you're to get a variable rate mortgage, you're looking at about 1.6%. And if you're looking at a 5-year fixed, you're looking at about 3.4%, which means you are about 1.8% difference between those two interest rates. And therefore, if you were to choose a variable interest rate today, it would take about 6 interest rate hikes before you would find yourself at the 5-year fixed rate that you could acquire today. So there's about a 1.5 to 1.75% runway that would allow you to save money. And keep in mind, for all of that time between now and when interest rates actually got to 3.3 or 3.4%, you would be saving money, and you would have to have interest rates go up substantially higher than that in order to cancel out all the time where you were saving. So it becomes this really interesting question and this really interesting risk question that you have to ask yourself. And the best way to ask yourself this question and determine the answer is to look at the actual costs. So I just ran on a mortgage calculator here. The difference is about $90 per $100,000 in mortgage. So if you have a $500,000 mortgage, it's about a $450 difference in payments. Now, you have two options. You can choose to pay $450 more right now, or you can choose to pay $450 less. And as interest rates start to come up, it'll start to cancel out the amount of savings that you have. Now, if you are smart about this and you say, okay, well, I'm going to take that $450 and I'm going to start putting it aside. And as interest rates go up, the amount that I can put aside will be smaller and smaller and smaller, but I will have that cash on hand then. At that point where interest rates do hit 3.39%, you would be in a situation where you could start taking that cash if you needed to and subsidizing your mortgage payments. And in my mind, that is the safest option. A 5-year fixed at $450 higher payments isn't necessarily safer in my mind, because it means all your money's going to the bank in order to hopefully have this safety somewhere down the road. Whereas you could be taking that money and putting it aside for yourself and making sure that you have it there if you need it as a backstop. And if the Bank of England's predictions become true and inflation starts to fight inflation, maybe you won't ever see interest rates go up by 1.5%. Maybe they only go up by 1% and you continue to save money over what you could have gotten a 5-year fixed at right now. But the opposite could also be true. You may end up finding yourself in a situation where maybe interest rates go up by 2 or 3%. And then the question becomes, are you willing to deal with that? And are you ready to deal with that when that time comes, if it comes? So it's all about having a plan and having a backstop for yourself to make sure that you're safe. And one of the fastest and easiest ways you can have that backstop is by not purchasing up to the limit of what you qualify for. And keep in mind, yes, Canadians have been qualifying at 5.25% for the last couple of years, and you have been qualified at significantly more than your actual mortgage payment. But at the end of the day, you want to make sure that you've got some room and some wiggle room in your income should something change. Because at some point in the future, especially if inflation starts eating inflation, if the head of the snake starts eating the tail of the snake, there are going to be job losses. There is going to be some sort of a recession, and you want to make sure that you've got a backup plan should you find yourself in a situation where you don't have a job or don't have an income for whatever reason. Now, with respect to variable versus adjustable versus fixed, for the most part on this channel, I use variable and adjustable interchangeably. But just so you guys know, the difference is this: a true variable rate mortgage, even though adjustable rate mortgages will often be called variable rate mortgages, a true variable rate mortgage typically has a payment that remains the same and an interest rate that fluctuates, which means that should we find ourselves in a situation where interest rates are rising like we expect them to, you could end up with a mortgage that ends up negative amortizing, or in other words, starts to take longer to pay off because your payment isn't changing, but your interest rate is getting higher. An adjustable mortgage, a true adjustable mortgage, on the other hand, has a payment that adjusts as the interest rates adjust. And this is the one that I recommend. The reason why is because a 5-year fixed mortgage is also an adjustable rate mortgage. The payment adjusts every 5 years when you go to renew. So what we like to see is clients who have an adjustable rate mortgage that adjusts with prime rate, so that if interest rates do go up, they start to see the payment increases gradually over time rather than all at once at the end of 5 years. Not to mention the fact that you pay a premium for a 5-year fixed mortgage in the form of a higher interest rate and higher penalties should you ever decide that you want to get out of the mortgage. Ultimately, though, the decision between a variable, an adjustable, and a fixed rate mortgage is yours and yours alone. It comes down to your risk tolerance and what you are most comfortable with. And I encourage you to go and get different opinions on this. Talk to your financial planner, talk to different mortgage brokers, talk to different bankers. By the way, if you've got a mortgage broker though, and you're coming to me and asking me, because I've had this a couple times where people in the comments send me a note or they find my email and they send me a note and they say, RBC is telling me I should do this, or Scotia's telling me I should do this, or I have a mortgage broker, but I'm not comfortable with their advice. Well, if you aren't comfortable with the advice you're receiving, I highly recommend that you look for somebody who can give you good advice. There are lots of really great mortgage brokers out there. And of course, Mortgage 360 is absolutely 100% always an option for you, assuming that you are in BC, Alberta, Saskatchewan, or Ontario. And if you're not in one of those provinces, we can help set you up with a mortgage broker who can give you the advice that you need and who is licensed in the province where you live. So if you found this video useful, do me that favor. As always, hit the subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video, and we'll see you on the very next one. Cheers.